Let's bring in Chris Weston now, Head of Research at Pepperstone, to talk about the markets. Chris, good morning to you. Thanks very much for joining us. So Donald Trump has kind of stepped back on these tariffs on China, or some of them anyway. How have the markets responded to that?
Well, I mean, he's given the bulls a bit of a Christmas present. He's given the consumers a bit of a Christmas present, and I think that's exactly what we've seen. I mean, we're just so used to just hearing bad news after bad news, geopolitical tension after geopolitical tension, that the markets that sort of have welcomed this news overnight that came through about 11:30 our time, that he was going to stagger the tariffs, this 10% tariff on the $300 billion. So he's going to tariff 130 at 10% starting the 1st of September. Then he's going to delay the bulk of that, or the remainder of that, until the 15th of December. So this is good news. We're not used to it. The markets responded very positively. We saw the S&P close up 1.5%. Gold got hit pretty hard. The dollar rallied against the yen. But certainly we've got a nice lead-in for our market today. You know, tech stocks doing very nicely on the session as well.
Why isn't the market pricing in this art of the deal that we've seen so many times from Donald Trump? Many of them tariffs are delayed. The ones that will still be put in place for now, and that'll happen just before Christmas.
Well, I think you've got to look at the goods that are going to be taxed at 10% in this tranche of $300 billion. Most of them are consumer-based goods. The other sort of goods that we've been seeing taxed over time are more facing sort of ag products and various factors. But this is very much a tax on the US consumer. So I think he's realised that this coming just at this point of the point of the cycle is not a good situation, both for China or certainly for the US. So he's going to stagger those. It's going to impact just before the US election. The US economy is not going to be as badly impacted by that situation going into the 2020 election. And that's what this is obviously all about. The Chinese obviously want to see the US economy weaken so that they can see a better chance for the Democrat government to get in. Better sort of tariffs longer term for those guys, and Donald Trump at the same time wants to make sure that he has the best possible support going into the election as well. So I think he's just realising that this basket of goods is a direct tax on the US consumer, and I think obviously he's reflecting that with the staggered approach today.
That's so interesting, isn't it, Chris? I mean, there's just tentacles everywhere when it comes to this. One of those tentacles, though, that we've noticed over, and I'm sure you have as well, over the last several weeks now, is the price of gold. It's sort of seen as a bit of a white horse in the markets at the moment. How much further do you see that continuing to rise?
Well, we saw extreme volatility last night. I mean, it dropped nearly 4% at one stage when Donald Trump came to Twitter and announced that staggered approach. And I think that's a reflection that right now, after this big move up from $1,400 up into, I think we got up to a high last night of $1,535, that there was just so much love for gold. The elastic band had been pulled, just a little bit too far, and I think people let go, and we've just seen a bit of a flush out of positioning. But I think longer term, I think there is good upside in gold. I wouldn't say I'm a gold bug as such, but I do think that what's making this work is this ballooning pool of negative yielding debt, $15.6 trillion of bonds with a negative yield. We can talk about that in great depth, but that's the issue. So as this pool of negative yielding bonds has grown ever larger, gold has appreciated. We've also seen certainly in the bond market in the US, yields falling and gold working quite nicely. It's been rallying in every currency, so gold's been working as a currency as its own right. It is what I call the best house in a very shabby-looking neighbourhood. So, I think against all those factors, gold's been working as a brilliant hedge in that situation. So I think it's got further to go. I think short-term, maybe a little bit more downside consolidation. I think longer-term, it's going higher.
Commodity prices have been down in recent days, but still well above the budget prediction. How is the federal budget looking? The economy not going so well, but it looks like we could be back in surplus already.
Well, I think we are. I mean, absolutely. I mean, those recent trade numbers in the current account, is looking pretty rosy. I mean, as a currency trader myself, we haven't seen the Aussie dollar really overly too sensitive to current account dynamics. Current accounts and surpluses give us, so much wiggle room. And I think it's really interesting now if you are looking around one of the big macro thematics, which is that the central banks do not have the firepower now to support economics globally longer term. So we have to turn to fiscal stimulus to get back in play there. And I think with that in mind, having a current account surplus is going to cushion us on the downside, some as potentially what we're going to see in Germany, where they're talking about breaking the budget, the balanced budget, and potentially spending more to try and help with climate change there. So I think having that current account is a good thing. But as a currency trader, and for people who are looking at the Aussie dollar, it hasn't been overly sensitive to what's happening in terms of trade, and certainly not in the current account dynamics at this point. But I think it will factor more later term.
Chris, when we've seen, just getting back to kind of China relations, especially with what's going on in Hong Kong, and Donald Trump has kind of pulled back a little bit on those tariffs. I mean, where does that fit in? How much of an issue on the markets is something like what's going on in Hong Kong at the moment?
Well, I mean, go back to what we saw yesterday when that announcement broke, that we saw the protesters shutting down, or the Hong Kong airport had shut down. US futures, S&P equity futures, dropped like a stone. So the market's shown that they are sensitive to this story. And I think now that in the last sort of 4 or 5 hours, there's been a growing amount of news that's coming through on social media about military operations in Shenzhen, and whether they're real or not, I mean, is obviously one thing we're looking at. But the idea that we could be seeing that military moving over into across the border into Hong Kong, and obviously how that plays down, obviously it's one that we're watching very closely. But the market has shown that they are sensitive to this story and the relations there between the world and China if this does turn more ugly than obviously that is feared. So we have seen a clear sensitivity to this story, and I think at the end of the day, remember that markets are a voting mechanism. They are driven by sentiment. They are driven by psychology. And I think, absolutely, what we don't need to see is just more bad news for these equity markets, because we've seen that there has been a lot of this. So it's a very fluid situation, and we're watching this one very closely.
And a snapshot in time, not a predictor, perhaps. Thanks so much for your time, Chris. We'll see you soon.
Thank you.